Welcome, everybody. Thank you for attending this week's Investor Roundtable. My name is Josh Lurie, principal here at F Street.
And you got Nick Jung here, Director of Development here at F Street. Thanks again for joining us. Today, we're going to talk about our Fort Madison, Iowa industrial acquisition and some of the other opportunities we have coming up in the pipeline.
So just a quick blurb about F Street. We are a real estate investment company focused on syndicating opportunities in the multifamily and industrial investment space. We have been in business for over 20 years and continue to grow our portfolio strategically. We syndicate each deal with investors and continue to grow our portfolio in Wisconsin and across the Midwest.
Yeah, and to go through a little bit of our industrial portfolio currently, right now it shows 2.3. We're now over 2.5 million square feet of industrial throughout the United States, mainly targeted in the Midwest, but we've also started acquisitions outside the Midwest in areas where we've seen good value. Again, approaching about 175 million in assets. For assets in industrial, we're continuing to explore.
And just to quickly highlight that, we have that portfolio that Nick mentioned. Some of those deals are development deals. Some of those are value-add opportunities. Most recently, we've closed in a deal in Indiana, Granger, Indiana, Maysville, Kentucky, as well as we have a Wheeling, Illinois acquisition coming up in the next 2 to 3 weeks. So this opportunity is in Fort Madison, Iowa, and geographically located in the Midwest as we're focused.
Yeah, so talking about our typical what we target. So physical assets, we're typically targeting properties. We'll call it as small as 50 to 100,000 square feet to 200 to 300,000 square feet. We're usually looking for value add opportunities as we talk about where we can create value, whether that's a short-term lease, maybe there's only a year or two left on the current lease with the tenant, or we can see some other value where we can create value in the building, bring in a new tenant, do mark-to-market rents. So we're usually looking to create those value opportunities for our investors for a short-term or a long-term investment. So just going over specifically coming into the Fort Madison acquisition. So this asset itself, 113,000 square foot building in Fort Madison, Iowa, single tenant net lease, triple net lease here. The current lease is set to expire in January of 2027. So that was part of what led us to the asset is, good asset in a good market, somewhere we're very comfortable. We call it a sticky tenant. Foam fabricators actually had this building built for them originally, almost 20 years ago.
Yeah, so we had the opportunity of actually going to visit the building. There's significant equipment and machinery where they're actually manufacturing the product to create these foam templates for various companies. For example, Whirlpool, which is about 2 hours away from the facility, where they're using these foam injections, shipping them to or driving them to Whirlpool, and then they're being used as packaging for the Whirlpool product. They also work with Omaha Steaks and several other companies. So about 30% of the square feet in the building they're using for manufacturing space, lots of heavy equipment. And then the rest is inventory management, warehousing, distribution, et cetera. So really like the asset. They've been in the building for a long time, as Nick mentioned. And what excites us about the opportunity is, number one, the tenant, the private equity-backed business, the growth of the company, and then the opportunity for us to create value through the actual lease structure. So we're not going in day one and making physical improvements to the property. The asset's in very good condition, but what we are doing, and we'll get a little bit into this, is the value opportunity and why we're excited about the deal is during due diligence, we have taken the opportunity to work collectively with the tenant to create a win-win where we are providing them something in exchange for them giving us a 10-year lease extension prior to us closing on the property. So Nick, let's talk a little bit about how that negotiation went and why we're excited.
Yeah, absolutely. So originally we went into this, we mentioned that the current tenant had a lease expiring in January of 2027. They do have 2 current 5-year options to extend those. In talking with the tenant, in building that relationship, we had a conversation with, hey, what do you need that we can provide value for you? Because we want you to be in here long-term, because for us, a long-term investment or short-term investment, creates value for our investors and creates value for the tenant for what helps them. So what we've worked out with the tenant, this has not been finalized, but we essentially have a verbal commitment to work with them, is what we're going to do is the lease had some odd escalators in it. So it had CPI, Consumer Price Index, escalators every 5 years, which created a big jump every 5 years, which made it a little more difficult. And the tenant was really looking to have short-term savings. So for us, what we did is we restructured it where they will be exercising both of their 5-year options. We're going to put them in an annual CPI increase between 2 and 4% based on the actual CPI as a floor and a cap. And we're going to give them 4 months free. So the next 4 months, they don't have to pay rent. That creates, almost $150,000 of value for them up front. And the CPI increases over the next almost 12 years they'll have on this new lease actually saves them likely more than that amount over that period. But for us and for our investors, that creates long-term value because we know we have a solid tenant who's backed by private equity, who's publicly traded, CODI, and by doing that, we're creating lots of value. And we'll come back to the sources and uses here, but just going on to how the structure works.
Yeah.
I'll let Josh go through that.
Yeah. So a little bit about the projected returns here. So the investment thesis on each deal that we're bringing to the market or to our equity investor group, they vary slightly, right? In this particular instance, we are looking because of the value that we're creating based on receiving term from the tenant from 2 years to 12 years. We believe, based on our market and diligence, that we've created a significant amount of value from our cost basis of what we're acquiring the asset for versus what the value is based on market cap rates where buildings are trading in that environment in Fort Madison, Iowa. So this just shows you what a $100,000 investment looks like. And as I mentioned, in this particular instance, because of that value creation, this most likely will be a flip, meaning in 12 to 24 months. So to ensure that we're getting long-term capital gains treatment, we will be realizing that value and going through a sale after month 12. So this shows what the cash flow looks like through month 14, assuming a sale in month 14. Obviously, as Nick mentioned, in exchange for getting that additional 10 years of term, we're foregoing rent. So that preferred return is not paid current up until month 5. So this shows, hey, on a $100,000 investment, this was what your monthly cash flow should look like. And Nick, if you can just kind of show what that looks like here.
Starting here, your first month. So I can draw here. There we go. First month we're showing here, and this is what Josh mentioned. This first 4 months, we're giving the tenant free rent.
Right. So as we have no cash flow in the first 4 months, investors starting in month 5 can expect this based on our projections and based on the lease amendment that we will be signing in the next few days here. And then with an eventual sale here based on our market analysis, which I mentioned. Now that can obviously be slightly more, slightly higher. This is a projection based on our sale estimate, based on a conservative estimate. And these are the financial metrics in terms of the internal rate of return and the equity multiple on that $100,000 investment that you could project. Like I said, these are estimates, but this provides a very reasonable estimate of where we believe the equity multiple and IRR will be based on these numbers right here.
You're right. And that's based on, right now we're acquiring this asset at a low 9% capitalization rate with the go-in rate with the current lease. This is assuming a high 7%. So that's that value we're creating is that 150 basis point spread between current capitalization rates of what we're acquiring the property for and what we estimate in, call it 14 months.
Right. And just looking at our exit, I mean, the reason why we can make these reasonable assumptions is really a function of that term lease that we're creating, right? That predictable cash flow for that future buyer. Because when we go into these opportunities, we always like to understand what our exit strategy is, right? And every opportunity is different. In this scenario, because of this value creation in a short period of time and to achieve long-term capital gains, we know that a 1031 buyer or a strategic buyer that's looking for predictable cash flow from a quality tenant, that allows us to buy at a 9 cap and sell at a 7 to 8 cap, right? So that's creating that spread on that future net operating income, which is how we're valuing the opportunity.
Exactly. And the other opportunity we'll look at on an investment like this is, we can't predict what the world's like in month 14. We can't predict what it's going to be like, as you probably saw the last 2 weeks, what it's going to be like tomorrow. So, but with that being said, we know we're buying a quality asset with a good tenant that's in a great business that'll be here for the next at least 12 years. or nearly 12 years. So in the event we're at month 14 here and we decide this isn't something we want to sell because rates have now dropped because of the last 6 months and we can get a really good refinance. We've looked at a scenario where we're at decent interest rates. Maybe then we return a significant portion of equity back to our investors, and our investors now receive that, and we cash flow for the next couple of years, or we sell in year 4, or maybe we even hold and sell in year 7 because we've returned 100% of your money, and we call that money tree. So you're getting a monthly check and you have your money back. So we'll really look at it just based on the market. This is what we're projecting at this point in time, but we just see this as a fantastic opportunity to invest in a great building and a great business.
Yeah, no, absolutely. And that goes for all of our investments. We have to define what our strategy is. With that said, we like to maintain some level of optionality and some flexibility just so we can execute in the best way in the best way for our investors and for us who are motivated and invested in these deals as well. So,
absolutely. And
yeah.
Just going back to the investment structure, as mentioned, the way we structure it is a 7% preferred return on all of the equity. That's accruing at all times. There is an exception on this property. As we finalize this lease amendment, if there is that free rent period, we're just not going to accrue any preferred return during that period, just as the investment structure because of that lease. But that's really not typical for our investments just because of the way this is structured. And then as mentioned, after 100% of equity is returned plus the accrued preferred return, that's when there'd be the 50-50 splits. And we call that, again, that infinite return, that money trees, where if you have all of your money back, you still retain that equity in the project. So going to the source and uses project. If you want to start
just a high level sources and uses here. This is meant to be a summary. We have a loan secured with a partnership bank of ours, local bank here, at 65% of our acquisition costs. The remaining funds, it's a pretty simple capital stack here, or sources of funds. We have debt, and then we have investor equity coming into the deal. It's a small equity raise of $2 million. We intend that. But we anticipate that this will go rather quickly just due to the size of the equity and the opportunity in front of us. And then the uses are on the other side, which show the breakdown of our costs. The largest one, obviously, being the acquisition cost of the building, but you can see that here. So if there are any questions on this or anything, feel free to shoot us an email after or ask on the call.
Yeah, one of the specific things just to call out here why the reserve amount is high. We obviously have like an operating reserve. We've done our PCA, our property assessment to see what needs to be done. The building's in great shape, so we really don't need many reserves. But this number is a little higher because that is accounting for those 4 free months of rent that essentially we're covering because we still need to meet our, $3 million debt service during those 4 months. And so we're going to capitalize that up front. And that's already baked into the model as well. So kind of just showing like how we're structuring this. We take a really specific actions and when it comes to arranging the debt, because the debt we've also lined up here on this deal, we've specifically asked for 18 months of interest only, and then to accrue after the 18 months there, so we can be flexible.
Yep.
And again, I'm going to leave this open to questions. I think we do have a few questions here as well.
Yeah, just quickly want to go through the critical dates. You can see it here. Because of the short time frame here, we are looking to open up the investment officially April 11th, which is tomorrow.
Correct. Yeah.
All funds due by April 23rd, and then we have a closing date scheduled for April 30th. We're happy to answer any questions, and we'll kind of open it up right now.
Yeah, and just to go through quickly on the why the quick turn here is working with the tenant, finalizing this lease amendment with them over the next week so we can get their free rent period to start May 1st. So we otherwise we'd have flexibility to close later, but we want to get the tenant what they're looking for. We see it as a great asset, and we want to move forward quickly on this this opportunity. Yeah, so the question was, can you expand on the terms of the debt? So we're currently finalizing the debt. We have a term sheet from one of our local partner lenders we really enjoy working with. So the current debt is proposed at 18 months of interest only. The current rate that they're going to be fixing for us is 6.35%. And then the 18 months after that would amortize on a 25-year amort. We also structured it more. We're paying a little bit more bank fees up front. Usually we're seeing 15 basis points origination fees. This one's a little bit higher at 40 basis points, but that makes it so we can be flexible on the exit, where if we're selling, call it month 14 or call it month 24, where the exit prepayment penalty is a lot lower. because we negotiated that to be, I believe, it's 25 bips.
And with that said, 40 bips is not out of market.
No.
Still competitive. And like Nick said, it gives us some optionality on the back end with our exit strategy.
Right. So that's kind of a built into right here to bank fees, total costs, everything for hiring the Iowa attorneys and making sure everything's good to go. Great question.
Yeah, the question is regarding our exit strategy, and it's a great question and something that we're constantly evaluating during the life cycle of the investment, right? And while we always go into it with a thesis, which is a flip here because of the significant increase in value over the short period of time as a function of the lease going from a 2-year to 12-year lease prior to our acquisition in 20 days from now. As Nick alluded to in the conversation, if rates drop significantly and we can recapitalize the transaction with our new appraised value as a result of the 12-year lease as opposed to 2-year lease, that will allow us to put additional debt on it to return about 50 to 70% of the capital and provide liquidity back to the investors, which is really important for us, right? And that's a priority: is how do we create the value and then recapitalize the deal to return equity to the investors while still having them maintain their equity ownership in the asset. And that's the concept of the money tree. So while we're going into this with the hold due to the value creation in a short period of time, we don't know where capital markets are going to be. We don't know where interest rates are going to be. With the value increase plus a dip in the interest rate, that allows us to secure a higher level of financing to still maintain our debt service coverage ratio, still maintain our equity cushion so we're not over leveraged, but at the same time, provide cash flow to the investors. So that scenario is feasible. We just don't know exactly where capital markets are going to be in 12 to 24 months from now. So we're going to evaluate these, and we'll be keeping investors apprised of this deal and every deal, through a quarterly update, which will go through our system. And if you haven't invested, our portal works really well for receiving information, and then our team is always available for a call to walk through any specific questions during that quarterly update.
Right. Yeah. As any investment, it's an estimate. We'll see what the market looks like. Lots changing right now, a lot's changing today, tomorrow, over the last couple of weeks, couple of months. We'll just continue to evaluate. This is just truly a kind of how we currently see the asset based on current market conditions and general forecasting we have going forward. Good question.
Yeah, good question.
Good question. So why are we selling the asset essentially was the question. We haven't, we talked about a minute ago here. We don't know. That's an estimate. We really don't know. As I said, there's a chance we hold this building for 20 years. It's really just dependent. As in any calculation of an IRR, as in any asset, we're always going to show some sort of exit, whether that's immediate or long term. As mentioned, there's a possibility we hold this building for the next 20 years. There's a possibility we sell it in 12 months or 36 months. Generally, as any of our investors know, we have a long-term thesis. For us, we always target a long-term play. This is just what we're estimating based on immediate value creation. The long-term asset as well, we look at it as a fantastic asset, great tenant. The other kind of related question was, is it going to be difficult for the tenant going forward? We would hope not. We always really value our relationships with our tenants and ensuring any smooth transitions, whether we're acquiring an asset or disposing of an asset. That's always, really critical for us because this is relationship business, and we really feel that we need to keep that value in that relationship with that tenant, and would hope any transition would be very smooth and easy for the tenant.
Yeah, absolutely. And just touching on that, I mean, our ownership team and our asset management team in-house works very closely with the tenants. It's part of our core strategy, right? Tenant relations, providing great service, because at the end of the day, we want tenants to be happy in their facility so they continue to stay in our facility, and we reduce the turnover risk and costs associated with that. So we take that communication part very seriously. In the event we do sell, we will be transparent with the tenant and provide a seamless transition for that future buyer of the property or future owner of the property.
That's a good question. Yeah. So the current question is, why is the current property for sale? From our understanding, we've had brief conversations with the broker and the seller. From our understanding, the seller is just looking to move on from specific assets. We understand the seller currently owns industrial assets throughout the Midwest and has made the decision to, either cycle those assets or I think maybe move to retirement is what we've gathered. We don't know anybody's motivation. There's always different motivations people have to sell buildings at specific times, but that was at least what we've understood as the current motivation.
Yeah, and also, with the term expiring on the lease, right? During, we were able to capitalize on that opportunity, which is another one of our core strategies, is we like to take some calculated risk with, call it some hair on the deal, meaning how do we create that value, right? If he were to do this, he would sell the building for a lot higher of a price, right? And we'd be paying a higher premium for that building, as opposed to us putting it under contract, in our ownership team meeting collectively with the brokers, with the tenant, to structure a deal that we could control, right? And that's what we did here, right? And that was the value creation and the opportunity for us to drive value for us and our investors. So sellers always have different motivations. In this case, retirement, moving on, and
defraying the risk, as you mentioned, because as mentioned, there currently still is only under a year and a half left on the lease, and until we finalize this amendment, which we're comfortable, again, we see it as a win-win for us and the tenant. There's inherent risk in that piece of the investment.
Definitely. Yeah. The question is, what is the minimum and maximum investment in the opportunity, and how much is F-Street investing? So we typically always say $50,000 is our minimum. There's never really a maximum in this scenario because of the amount of soft commitments we've received at a high level. We're likely going to cap it, but with that said, we typically operate on a first come, first served basis, just to be respectful of everyone involved in our platform. So not necessarily a maximum, but we're going to work with investors. If people want to get in, we want to allow them to be in on the opportunity. So our team here will work with you to get involved if you want to be involved.
Yes.
The next question.
How much is F-Street investing in the project? As we always say, we always leave it open to our investors to fill that portion for the investors looking for investments. The principals already have committed funds to this investment as soft commitments. But again, we will either parse up or parse down our investment portion to ensure the transaction closes.
Yeah. The reality is we always want to generate exposure, and we want to invest in these deals because we like the opportunities, right? If we can align with our investors, it's positive for us and our investors, and we understand that we want to be involved in these opportunities. That exact amount varies on the opportunity. It's traditionally what I tell all investors is we try to be involved for 5 to 15% of the total equity involved. I don't know the exact amount on this opportunity, but happy to follow up with anyone on that.
Absolutely. And then more questions. What expenses is F-Street responsible for is the question. When it comes to the actual lease itself, it's actually an absolute net lease. Essentially, the tenant is responsible for almost the entirety of the asset. There's really minor call-out items in the lease. Happy to dive into those details if somebody wants to reach out personally, but essentially the tenant's responsible for almost any and all expenses as it relates to this building. The question is the lease restructure a condition for closing? With the seller, it is not. For us, as I said, we're pretty comfortable and confident it's going to happen. If not, we obviously want to be very transparent with our investors. We would eventually intend to close in this transaction if it didn't happen, because we see it as a great asset. We do think the tenant really enjoys the building. I mean, Josh visited with our team, and they seem to love the site. So we love the asset either way.
Yeah, and in addition to that, I mean, we have sent the amendment. We have a verbal commitment. It is not signed yet. We have a verbal commitment that they intend to sign it. We're working on that actively right now to wrap that up, and we're hoping to have that wrapped up this week.
Yep.
Yeah. Great question. Yeah, I mean, as we like to maintain optionality and flexibility to execute on the investment, we can't guarantee a sale in month 14 or month 12 to 24. As we mentioned, it might be a recapitalization and a cash flow play for a period of time. So if you're not comfortable with some of the uncertainty in terms of sale or cash flow strategy, maybe it's not the best investment for you. At the same time, we're confident in the opportunity based on our basis, and we believe that either strategy will provide or yield nice results.
Yeah, absolutely. And I think that goes into our pipeline here, just talking about our pipeline, the type of assets we're looking for, the size, the basis, the quality tenants, the long-term value. Because for us, again, we look at this as long-term value for our investors. And again, it could be an immediate sale, it could be a long-term hold, like any of our assets we're looking at, and all of these states that we are currently actively negotiating. We see this as a great opportunity.
Yep.
Good question.
Great question. Yeah. So really good question. So because of the
question.
the question.
The question was, if we move this to a long-term hold, would we do a cost segregation study?
Yeah. So if we end up not selling it after year one, we would likely consider and evaluate a cost segregation study with our accounting team. So yes, that would maximize our tax benefits to the investors. And it's something that we absolutely would consider doing, like we do on all of our transactions.
Right. If we were kept as a short-term hold, we would unlikely to do one.
Yeah.
Perfect. So no more questions. So again, with the pipeline, we will have more investment opportunities coming forward. We're evaluating deals each and every day. This is just one we will be releasing officially tomorrow. We also wanted to talk through, we're going to be closing on F Street OCLV MF3 here in the next few weeks. There is a very limited availability for this asset. So if anybody's looking to get in on this asset, again, it's our next phase in Oak Creek. We see it as a strong IRR. It's a fantastic long-term hold for a master plan community we've been working on for coming on 5 years.
Yeah, super excited about this opportunity. We have a great public-private partnership, about $3.3 million of additional value through a pay-go TIF over the 19-year period. We've proven the market concept. We built 199 units at the end of 2023 and quickly leased that within 8 months. This is phase 2B or phase 3 of the multifamily in Lakeshore. It's an amazing development. We're happy to do tours and have you check that out, but really excited about starting construction later this month. We have about $1 million remaining of investment roughly and looking to close that. So we are available if you're interested in learning more about that as well.
But again, we want to say thank you again for everyone's time. If you're looking to invest in OCLV MF3 or into our Fort Madison asset, please reach out today at fstreet.com or reach out to us individually.
Yeah, thank you all for joining. Have a great day.